Hello. Today I'm joined by Ollie Beckett, Fund Manager of the TR European Growth Trust. So, Ollie, to start off with, could you give a quick overview of your investment style and approach?
Okay, well, TR European Growth is investing in European smaller companies. So in its simplest form, look, we're trying to buy companies that are going to grow, i.e., companies of the future, if you like. But valuation is important to us. So we're trying to find companies where we think they are undervalued, and if you like, the perception of the market is wrong. And on the back of that, we'll do lots and lots of meetings and calls with management teams, to try and find those inflection points and those exciting growth stories of tomorrow.
So, you seek to find companies with exceptional growth potential. So, what qualities do you look for in order to find them?
There's no specific sort of qualities in a way. We're clearly as companies that are going to deliver top line growth, but top line growth is not enough. We're looking for companies that generally are going to deliver profitability and cash flow ultimately. But that can come in many areas. I mean, if you think about things logically, it can be in new areas like in the ESG world, where sort of energy transition and we sort of move towards sort of electrification. It can be in a number of different areas. I mean, everyone knows out there where the sort of growth areas of tomorrow are. So we look in those areas, but also sometimes it comes in unexpected areas.
The trust's performance over the past year is very strong. I mean, how would you assess the performance of the trust during both the sell-off and the subsequent recovery that has taken place since last April?
During the sell-off, actually we struggled initially. We weren't prepared in some ways for the impact of COVID or how quickly it hits and the impact of that. So what we did is we got rid of any companies which were leveraged, i.e. companies because we didn't know when the recovery would come. We didn't know how long it would take. So any companies that had too much debt, they got out of the portfolio. Otherwise, we ran with the ideas that we had. And so slowly things have recovered. Also, I would say that, with the Pfizer vaccine coming to the market and Biden being elected, we've tended to outperform as we've sort of recovered, as people can see through the pandemic. We've also tended to outperform because we're slightly more value orientated when people have had increased inflation concerns. Because a lot of our competition, they own companies on much higher valuations. We really do care about valuation. Yes, we're looking for growth, but we care about valuation.
Wanted to move on to portfolio composition. Could you highlight some of the winners and the losers as well from the pandemic, and whether there's been any recent portfolio activity in terms of sector weightings or changes to holdings?
No great sector sort of changes, really. I mean, we're overweight if you look sort of consumer discretionary because we expect a lot of pent-up consumer demand. And we're underweight areas like real estate and actually slightly healthcare where we find valuations a little bit stretched. So no great changes there. I mean, the winners during the pandemic were a number of the sort of online companies, as you'd expect, as we're stuck at home. So online retailers did very well. And companies, focusing on things like home furnishings. So companies like Westwing in Germany, which, you can order cushions and candles and lots of stuff I would argue you don't even really need any more of in your house, but there you go. Where we actually continue to think those companies are well placed, they've built up a new customer base. Other companies we have sold out of that did very well during the pandemic, whether it is companies like the online pharmacies, where people all got very excited about the transition, but we think valuations got ahead of themselves. So it's been very stock specific. But a lot of the winners of last year we have sold out of. Things like Cinch as well, things doing sort of messaging, i.e. telling you've got an appointment at the GP or something, because we just think valuations are too stretched. Others may disagree, but that's where we are, as I say, keeping that valuation awareness.
And what have been the recent new holdings in the trust?
It's been a combination. We've bought into some IPOs, so things like Montana Aerospace, might be unexpected because you think aerospace, that's got to be struggling. But they've actually been taking market share with the sort of Airbuses and Boeings of this world. Other IPOs, such as Smartcraft, providing software for the building industry, an area which is sort of lagged, if you like, in software solutions. But we've also bought into existingly listed companies like Barco, where we expect a recovery. They're doing laser projectors for the cinema, and they also do something called ClickShare, which helps with, well, things like this, video calls, which we think will recover over time. Other individual companies like Fnac Darty in France, which is predominantly an electronics retailer, but also has a sort of ticketing business and things like that. Where so sort of these recovery stories as we come out of the pandemic, we think they will do better. So it's been very much focused on individual stocks.
The trust has 135 holdings. How do you ensure that the portfolio is not over-diversified, a term that's coined by some as diversification, due to holding that large number of holdings?
Yeah, sure. I mean, look, that's a new word for me anyway, but fair enough. Look, firstly, I'd say, look, we've had a large number of holdings throughout, for better or for worse, when performance has been good or not so good. But, broadly, performance has been good and we've had a large number of holdings. Why do we have a large number of holdings? Well, we tend to go down the market cap scale more than our peers, but we want to maintain that flexibility. We want to be able to invest in those early stage companies. An early stage company for us that's been very successful has been something like HelloFresh doing meal kits. So that willingness to go down the market cap scale means to maintain flexibility and liquidity, we have to have a large number of holdings. So look, I don't apologize for it. It's not what you call a focus fund, which sort of a lot of people might like from a marketing perspective, but it's worked for us and it's delivered decent performance. So I'm happy with it.
Ollie, thank you very much for your time today.
Thank you very much.